Good morning, good afternoon, good evening, folks. We are about to tackle a topic with Mr. Greg Dickerson that I know you probably are thinking about. I know I'm thinking about. I've lived through it a couple of times already in my investing career. And Mr. Greg Dickerson, we're going to talk about real estate and a stock market crash. What do you think?
Yeah, let's do it. I think we have both on the forefront, and the market's correcting as we speak.
There you go. So let's paint a picture. This is just a what if. This is dominoes. These are things to watch. So let's just say the stock market. We're talking Dow, Nasdaq, S&P. Over a week or 2 week or 3 week period takes a loss. Let's say 25%. Right? Whatever it is, the stock market's at X. It falls 25% in a brief period. Let's call it 2 weeks, actually. Right? Down. It's down enough where people pay attention. They go, "Ooh, my 401k is a 201k." All those things we hear in a stock market crash. But what I want to play out with you today, Mr. Greg Dickerson, is what happens to real estate when people's wealth gets whacked 25% in the stock market. What do you think first?
Yeah, it's an interesting conversation, and we could go back and look at case studies where that's happened throughout the years. But we did a video the other day. More wealth is being built in real estate in the next 10 years, built and destroyed, and all that.
Yeah.
And what's interesting is more people have built wealth in real estate without doing anything in the last 2 years, just because if you bought a property,
just hold it
anywhere.
Yeah,
it's gone up. So what goes up must come down. And we've seen these boom and bust cycles. And I get a lot of people pushing back on me saying, real estate prices will never go down. I've heard that my whole career.
Yeah, me too.
And we reached a peak 0405, it corrected a little bit, then it went up 0809, then it shot down, and it took until 2000, really 14, 15 to get back to where we were 0405. And again, what we're experiencing now, what everybody's got to remember, this is not normal market conditions. The only reason we are where we are in real estate, financial markets, cryptocurrencies, anything you want to look at, equity capital, multiples on companies that you can sell, unbelievable right now in terms of multiples, cap rates, and valuations, because of what the Fed has done from March 2020 till now. It went off a cliff and off to the races all across the board. So if the stock market is correcting to that degree, then there's a fundamental issue underlying that correction in the economy. And that's going to affect all asset classes across the board. And it's going to reverberate around the world, because it's not just the United States. You got to remember, we're a globally connected economy. Everything has gone through the roof everywhere across the world. And as we correct, markets around the world correct and come back with us. So that sucks, liquidity out of the market and out of the economy, which ultimately deflates all asset classes, including real estate. And the only thing that's interesting is, what does the Fed do in that regard? Do they let it go? Do they let it correct? Because arguably we should be about 25% of where we are now in terms of normal market cycles and growth, based on real valuations of companies, especially post-pandemic. So if you go look at where we were before March, we were kind of still in a little bit of an uptrend. The economy was doing good. A lot of QE since 0809. So we still had false liquidity in the markets because the Fed had not taken the foot off the gas yet. So they'll probably try to eke a little bit out and kind of keep things propped up so it doesn't completely collapse and we have a disaster like we did 0809. So that could create some issues there. But I think interest rates will rise as the market corrects, and we'll have kind of a double hit there. And I think you will see real estate assets start to taper off, because there's a lot of liquidity coming out of the markets when profits are made going into the real estate market and things like that. People feel more confident. If the markets are tailing off, assets are getting devalued, that affects confidence in a lot of the other markets. So I think you'll see real estate correct right along with stock markets. I don't know to what degree, because again, it's an interest rate driven environment.
Right.
So it really depends on that.
Yeah, when I look at this, and again, I've been doing it 20 years. We've seen this a couple of different times, and I think the reaction might surprise people. First and foremost, you got to break down, when you talk real estate, you got to break down owner occupied versus investors, for sure. Right. I think owner occupied is clearer, at least in the Bay Area. Right. I'm in the Bay Area.
And we're talking housing market, not commercial assets.
No, housing. Exactly. So one thing that's going to happen in owner occupied land, because a lot of the down payment, at least for lots of buyers, is held in stocks, right? RSUs or options, or, all of that stuff, right? Most people putting down payments, they're going to extract it from their stock portfolio. So historically speaking, when stocks get whacked, people aren't as interested in taking it, right? They don't want to take the loss, or they think it'll come back or whatever. So I think what will absolutely happen in owner occupied world is you will see what I'll call above the median, which is where, the conventional or traditional buyers are putting 20% down. That market slows down and could very likely ground to a halt, is my first thought. And then when you think entry level first time home buyer, I don't think that will be as impacted as much, because you're talking 3.5% down. Those folks probably don't have the same kind of net worth in stocks. But that's kind of my first breakdown of owner occupied world. How does that feel?
Yeah, that sounds reasonable. And again, a lot of it depends on what the Fed's willing to do. They're buying mortgages right now, mortgage-backed securities. So what's going to be the effects on that market if and when the market corrects, and how will that affect the ability to borrow money? Generally, if you're seeing markets correct and things like that, they're going to be looking at borrowers a little harder. So, the requirements to get a loan could get a little bit more stringent, credit score requirements, debt to income ratios, things like that. So it'll be interesting to see. Now, 08, 09, the housing market went down exponentially with the stock market, but it was because the market accident was in housing that created the stock market problem. So that was what triggered it all. And that's what started bringing the banks down. This go around, the liquidity is the problem.
Correct.
So the market accident this time is going to be, reducing liquidity in the markets and asset valuation. So that's your accident this time. Question is, how does that affect real estate? And again, it's all about interest rates. It's all about the availability of capital for mortgages.
Mm-hmm.
So arguably, if the markets are going down, there's not going to be as much capital available to go into mortgages. So it should create a situation in the housing market, but to what degree, until we get there, it's going to be hard to say.
Yeah, I would say this at a minimum in the owner occupied line, it would be a slowdown. I do think the slowdown will be greatest above the median, and wherever market you're in, the higher priced homes will sell slower. Because again, those people traditionally take larger portions of the down payment comes from stocks. So my history says they will slow down. The owner occupied, right, the 3.5% down FHA below the median won't be as impacted with my history. But let's flip the script now to investors. Let's talk investors, landlords, mom and pop, 1, 2s, 4s, things of that nature. What I saw, and again, the 08, 09 crisis, I actually want to go back to the .com crisis, right? Where my journey starts. It is actually pretty interesting, right? So the initial reaction was very much like owner occupied world, right? Where it was just a slowdown. It's like, okay, my stock portfolio went from X, now it's X minus 25%. Got to figure it out. But what we saw coming out of that, like 2001, 2, 3, it's the beginning of the real estate boom. That was before we got wacky with loans in 05, 06. But what we saw, and I saw it up close and personal because I was in it. I was one of these people, right? I was burned by the stock market. I now call it a casino. I'll never go back. And there were lots of us. And what happened is we started to see real estate as tangible. You could touch it. You could learn the market. You started to understand that a house could cash flow. $107,000 house at 1,100 could cash flow. You can find a fourplex. So what I think might be a ramification if the stock market is severe and people get significantly hurt is just like 20 years ago, they don't go back and they find a more tangible asset. And it won't be immediate, but we saw a pretty clear wave of people leaving the stock market and going to build little portfolios. Did you see that then? What do you think?
Yeah. So for me, I was in a resort community at the time, the Outer Banks of North Carolina. So these were all second home, vacation homes, rental properties, short-term vacation rentals before that was even a thing, like it is now everywhere, with Airbnb and VRBO and all that. What I saw during that were people that made a ton of money off the stock boom, and they were coming down buying beach houses and renovating them and doing all that kind of stuff. So we didn't really see, once that bubble burst, I don't know that we saw a pullback there because we were in a more unique type environment. But I tell you what you can see now is people more in tune with it now. People will cash out and liquidate, which is what's going to cause the correction. And then they'll be looking for a home for that capital. So I think you might see, it's just like anything else. You'll see more interest in real estate investing, things like that, especially if there's inventory available, things like that. So you could see it being a plus for the housing market, it's all rotational, right? So as
Yeah,
the stock market sells off, what's going up? The dollar. Gold arguably should be going up, although
true.
that was selling off too.
Yeah.
Commodities were selling off. So that just tells you there's bubbles everywhere. The only place people feel safe right now is cash. And then at the end of the day, when the dust settles, they're going to be looking for somewhere to put that cash.
Yeah.
So your options are going to be, well, do I want to do this whole stock market thing over again and risk it? Do I want to do gold where, that's a more slow long-term play, or do I want to get into some real estate where I can generate some income, get some appreciation? Who knows what the taxes are going to look like? So
Yeah.
we did see a lot of that after people cashing in. Again, I saw people cashing in, they were putting it into real estate.
Yeah. Again, I saw it. I was one of those people. And I think it'll happen again. Because again, people will go to cash out of fear. They will sit there for a while. It could be weeks, months, quarters, but it won't be forever. And then they're going to look for a home. My suspicion is people who get really burned in the stock market will be just like me. It's like, damn it, I'm not smart enough to do it. Wall Street's a casino. Wall Street's rigged against the little guy. I can already hear all the things, right? And they're like, I'm going to go to real estate because I can learn a market. I can do the work. I can touch it. I can feel it. You hear all these things. So I think that little, 1 through 4, maybe it's vacation. Maybe people do Airbnbs because it's very different than 20 years ago. I do believe that investment real estate, after a little delay, we'll see a lot more love because cash needs a home.
So I'm good at calling tops, and I always say to everybody, okay, it's better to know the top than it is the bottom. So I'm 1 for 1 on the bottoms. So I called the bottom in 0809 and I jumped in there. And in March, I skipped it. I thought it was going to go deeper, but the Fed jumped in and tricked me.
Yeah.
So I missed the bottom.
Yeah.
I missed the absolute bottom in March because I thought we were going down further before, we started heading back up. Yeah. So I missed that a little bit, but I did call the top both times. And the top was that 2019. So we were reaching a peak in markets in fall, winter of 2019, when the Dow was approaching 30, and you and I were having those conversations.
Absolutely.
And I went on record, I was wrong. I said that we'll see Dow 15 before we would see Dow 30. We were headed to Dow 15 until March happened and the Fed jumped in. Yeah. So that was the peak of the market, was the end of 2020 before that correction. And I told everybody, look, go to cash right now, go to cash. And sure enough, that would have been the play for people as it tailed off going into March, and then they could have jumped back in. So what I'm going to say right now is you need to be in cash right now. If you're in the markets, there's not exponential upside to your investments right now versus going to cash for a while, let this kind of thing shake out, and then jump back in at some point if you want to, or get into something else as the market corrects. Yeah. But we're at a peak right now in every asset class all across the board. It's a great time to go into cash, and that's why we're seeing corrections.
Yeah, this is going to be interesting again, folks. We're due for a correction. It's going to be painful, a little bit quick. The beauty of people just don't realize is the correction could be so fast. I mean, crypto will be hours or a day. Stocks will be days or a week. And
it goes quicker than you think. There's for everybody listening, there's a chart out there called the Psychology of the Markets, Wall Street cheat sheet.
Yep.
And you'll see the cycles of the market and where people get in that denial phase.
Yeah.
The market will trick down on you fast. And then boom, then you get that last big slam when everybody starts to panic. And it happens quicker than you think. So I know people will argue and all that and whatever. I'm just saying, for me, cash is a great place to be right now.
I'm disproportionately that way as well, folks. So Mr. Greg Dickerson, thank you for your time on this great Monday. How can people follow you?
Yep. GregDickerson.com, all my YouTube channel, podcasts, social media, it's all there. GregDickerson.com.
Thank you, buddy. We appreciate you here on One Rental at a Time. Michael. Thanks again.